Yeah, so Miles, firstly, thank you so much for joining us on this webinar, last webinar of the year. So it feels like doing one or two a year. I'm looking forward to the break. So Miles, why don't you just take it away and just tell us a little bit about yourselves, about JPES, how you came to your conclusions, and what we'll do is we'll go through your research and look forward to the conclusions we may or may not have.
Perfect. Thank you, Paul. And well, thank you everyone also for dialing in today. So just to introduce myself, I've spent the last 20 years in financial communication. So initially as a financial journalist, and then about 10, 15 years ago, moving into marketing and comms. And for those of you who don't know who JPES Partners is, we're a specialist marketing and communications consultancy that just focuses on investment management and the real assets industries. So we advise clients of all sizes, from boutiques through to the big players, consultants, fiduciary managers, and our advice centers on content and messaging and that sort of corporate narrative. So that's really where a lot of the research that I'll run through today is focused on sort of content and some of the key themes that's happening in the investment space.
Wonderful. And we had a great event last week, wasn't it, Miles?
We did indeed. I was Paul very kindly attended our investment seminar last week. So first time we'd done it in person again since 2019. So I think the last slide actually I have is from that research.
Oh,
so
fantastic.
Paul's already seen it, but it will be new to everybody else, hopefully.
Great. Well, Miles, it's great to have you on this webinar. I'm sure our audience will really get a good sense of what you guys do at JPES and the value of your research. And if in marketing you're not, well, marketing is two things to me. One, it's about creating subjective value and having a gut sense of what may work and what may not work. But marketing without data is kind of pointless, because it's very hard to justify any spend, any kind of investment in what you're doing. And obviously the big thing is marketing ROI or MROI, whatever you want to call it, is justifying that is incredibly important. When a marketing team or a content team is looking to get more budget or to get a pay rise, it's so important to have that running in tandem with any kind of sales and marketing activity you're doing outside that. So fantastic. So Miles, take it away, sir.
Okay, so where are we? So the first slide. So there's a few pieces of research I'll touch on, but the main one is the Investment Communications Trends Report. And this is an annual perception audit that we conduct each year. And we talk to around 20 heads of communications or marketing at asset management firms with a range of sizes to get a good view across the industry on areas of best practice in comms, content creation, digital, through to broader themes like private markets and ESG. And so this slide in particular is looking at the content that's being produced by asset managers. So it could be press releases, but it could be reports, blogs, or white papers, but all that content that they're creating and sending out. And it's really changed significantly over the last 5 years. And specifically, this is looking at content they create and send to media, but there's quite a close correlation between what's sent to media and clients, actually.
Right.
And so this is 5 years ago when we started this report. We termed this the kind of the wall of content, because we estimated that investment media were getting upwards of about 300 pieces of content every single day just from asset managers, and that's in the UK. And then the next day another 300 and another 300. So
wow, 300.
Far too much it could ever be used. I mean, it was just a crazy amount. And we have seen it begin to come down, and we can kind of see on that slide. But there was, the one firm we spoke to, quite a big name actually in the UK, and they were producing a minimum of 2 or 3 pieces a day and sending that out, and they were kind of cannibalizing their own efforts.
Right.
There's only so much you can report on, and in the conversations with them, I really saw that has changed in the last couple of years. So this particular firm, when I spoke to them in 2021, they'd halved the amount of content. Spoke to them again this year, they've halved it again from there. There's a real shift and an understanding, I think, of the need for that kind of quality over over quantity.
Right.
And that's a quite extreme example, but I'm seeing that from other people that we're speaking to. And I think it's that kind of understanding that you're not in a vacuum. It's a really competitive space. I mean, the UK actually is one of the most competitive for investment media. Right. And, you know, this is maybe to do with journalists, but actually it's very relevant for clients as well, because if the media are getting lots of content from all these managers, so are clients too. Probably not as much, but also getting too much. And so it's kind of understanding that broader context, and that's why it's always important, I think, when we start with this sort of slide, to understand also what your peers are doing, and understanding the importance of, if you have got some content and you're trying to get that to land with clients, that it really needs to sort of cut through, and you really need to think about what the client wants. And I mean, it was interesting. I think I mentioned this to you before, Paul, but there was a study we did in April 2020. So amazingly, getting on for 3 years ago now, but at the part of the pandemic. And we were speaking to a couple of investment consultants and trustees around the way that what asset managers were communicating to them, and what worked and what didn't work. And it's kind of very relevant to this, really, because they were saying, hey, there's too much, but also it just needs to be short, it needs to be clear and transparent. That's reassuring to me. But the more that the longer a piece of content is, the more words there are. Actually, often I feel like the manager's hiding something, and I'm very wary of that. So actually, it's kind of those really long pieces and doing it over and over and over. Actually, it starts to have the opposite effect to what the manager wants. So keeping it short, sharp, pithy, tailor it if you can, but just make it as easy as possible for the client. That's kind of generally the best advice.
Right. And do you think that's because there's a lot of content, as you said, being generated? Or do you think people have started reading things in a slightly different way, that people are scanning more than they're actually reading?
Yeah, absolutely. I mean, I think you've got to grab someone straight away in the first paragraph or two. People will stop reading, but I mean, very few people read full long reports. I mean, that's why you need exec summaries. I mean, if you think of the way you consume news, even, I mean, most people will see a notification on the phone. They don't even read the story. They are aware something's happened and move on. Our attention spans are so short nowadays, that yeah, absolutely. And that's why, I mean, we do the same, you know, it doesn't matter who the audience is, whether it's a client, a journalist, whoever the stakeholder is. If you've got a long piece of content, you should be able to summarize that into 3 or 4 key points. And if you get their interest, they'll read the rest of it, possibly, but don't keep the exciting, juicy bits to the end, because most people will never get there.
Yeah, and that's what I mean, you know, what you're talking about here is exactly what the analytics we have in ProFundCom have shown over, you know, the evolution of TikTok and short form content versus long form content on, say, video or long commentaries. We've definitely found that the shorter the content, the more it's kind of laid out to talk about the transparent issues. So if you're a fund and you want to talk about, you know, your attitude to risk, your investment strategy, your performance, having whatever you want surfacing really quickly in kind of that exec summary, and then, you know, adding more, you know, and more you kind of scroll down the piece, the more information is laid out. And, you know, we've also looked at, you know, information density as well. So when, you know, you are putting a dense bit of content out there, which is absolutely fine, even going down to the spacing of, you know, how the content appears on multiple devices is worth looking at.
And it's I mean, the point I made earlier, but you're right. You need to always think about the end reader and make their life easier, whether that's a client, a journalist, or whoever it is, whether it's the way you lay it out or the content itself. It's whatever makes it easier for them. Means they're more likely to want to consume that content going forward.
Yeah, and funny enough, I don't know whether it was the same person you spoke to, but I spoke to probably that person's doppelganger, who actually said completely the opposite. I said to this guy, I said, man, this content is really hard to read. You know, do you really want us to kind of put this out there? And he said, it was difficult to read. It's going to be difficult to, you know, it was difficult to write, so it's going to be difficult to understand. And I said, look, are you really sure about this? And he said, no, I'm absolutely sure. I said, look, okay, let's do some A/B testing, right? Let's take this big article you have, let's chop it down into four bits, part 1, part 2, part 3, part 4, and then we'll send it out based on our data and our engagement analytics and how we see people consuming data, and you send yours out, and let's see the difference. And it was an order of magnitude different in engagement. So yeah, and it's also really interesting, you're talking about frequency. So how did you kind of measure out the fact that sending more, actually doing more, you can do more by doing less?
Well, I mean, to be honest, if you're producing 2 or 3 things a day, it's very difficult to make that really good quality content. It's not.
Right.
I think 5 years ago, it was a kind of a content land grab, and people were just sending out as much as possible, and some bits will stick and some won't. And it was kind of understanding, if you're going to do something, make sure that A, it's of quality, but also, it's what I've said before, really, you keep the end audience in mind, whoever that end audience is, and are you adding value to them? Are you helping them out? Are you, if it's to a client in the middle of the pandemic, are you kind of explaining what's happening right now, but what that means for their investments? Is it something they need to know and it's going to be useful for them, or are you just adding more to the noise? And if you're adding more to the noise, it's probably not worth it.
No, great. And that it is, it's like, whilst there was a time Bill Gates was saying content is king, it's more to say relevancy is everything.
Absolutely. Yeah, content is still king. It's just, it's got to be decent and, as you say, relevant.
For sure. And it's really, I don't know whether you've found this yet, but copywriting is an art, isn't it? You find that?
Yeah, absolutely. And to different audiences as well. I mean, we're looking at investment here, aren't we? But I mean, each sector has its own acronyms and jargon and technical language. And, there are specific and very good copywriters in every industry. I mean, even in our industry, there's some that have emerged that that are really, really good at what they do, but many that aren't, and it is a real art. And just learning to tell a story.
It's all the story, right? He who has the best story wins.
Yeah, exactly.
And that is a fact, right? And it is the story. And don't you at JPES create content?
Yeah, so we do, absolutely. So we, I mean, we'll create content for clients. It all really depends on client needs. So, I mean, certainly within asset managers, sometimes the fund managers are very, you've actually got some great writers at asset managers. It's more about, transforming that, translating it into something else. Sometimes we'll actually produce big, large reports. So one of our, Adam, actually, one of our associate directors produced a massive report in the middle of the pandemic for a client on the case for aviation finance at a time where it didn't seem like there would be a case again for a long time, drilling down to lots of forms of data. So yeah, it's again, it's always to what the client needs, but as we say, we try and make sure that it's as relevant a time as possible, which is why we do all of these kinds of insights and the insights that you saw at the seminar last week, to make sure that what we are producing and recommending and suggesting to clients is as relevant to their end audience as possible. No, dude, and it's great to know that you've caught all this data for the last 5 years. So moving on, I suppose, what makes good content? I really love this slide. So do you want to take us through what you consider as good content? Absolutely. Although I will say this is not what I consider, this is what asset managers consider. Right. So although I agree, so I'll confirm, but again, it's from the same report. So this was what the asset managers we spoke to felt worked best with media. But again, it's as I keep saying, there's a really close, good content is good content, and there's a good close correlation with clients again. And so overwhelmingly, most people, half were saying, you need a firm opinion. You need a reason for writing it, and have an opinion. Don't just summarize facts. And that really. So I did a research project for a client a couple of months ago, looking at their own content, but then comparing it to 20 other asset managers, and we literally analysed every single piece of content going back a year for them and all of their firms. And it was the firms that had similar investment approach. So it's kind of trying to compare apples with apples, and trying to find ways of how do you sort of measure what good content is, because it's a hard thing to do. It's sort of subjective, but we came up with three sort of three key areas actually that really constituted good content. And the first was relating it to the news agenda, making it timely, because that's relevant for everyone. The second was having a strong opinion, and it kind of goes back to actually what the asset managers were saying here works well, is if you're going to write about something, have a view on it. And then the last one was some sort of call to action. So, I mean, good content for an asset manager, it should make you want to invest with them, or at least find out more about that particular product. But yeah, it's interesting. So when we compared 20 firms, the one area where most did really well was actually relating it back to the news agenda. So actually asset managers and all the people writing it, fund managers or content teams, were very good at that. But where it starts to fall apart, and there wasn't consistently strong content across all firms, the big issue tends to be what the asset managers will summarize the facts, and they'll give lots of news of what's happened recently, but not necessarily an opinion on what that means. And that's what whoever is reading it, generally, let's say a client, if they're going to be reading a piece of content from you, they could read in the FT that oil prices have shot up or tech stocks have crashed. They don't need to know that, and they'll probably read it a week or two earlier. What they want to know is, well, why are you writing about this? What does it mean for you? Does it enhance your investment case? Does it detract from it? It's that kind of that opinion which makes it really interesting and relevant. And it's surprising. It was surprising how few managers do that well. And it's why people are investing with them, but it doesn't always translate into the content. It sounds self-evident that they would do that, but it doesn't happen as frequently as you would expect.
So, I mean, there has to be a fine line between opinion and advice.
Well, I mean, I think most firms will probably steer clear from trying to advise in the content. And also it depends, but obviously each website will have different restrictions in terms of jurisdictions. But I mean, a fund manager is probably not going to advise you to invest in tech stocks now, but they can give you a firm opinion as to why they think there's still value in there, or why not, or why they're choosing to not invest because they don't think there's any growth left and they're looking in other areas. It's just understanding what they're looking for and where they see an investment case or don't see an investment case.
So when a fund manager is actually putting an opinion piece together or putting some thematic research together, how good are they at themselves at doing it? Or is this something, because we have found, when we're working with asset managers, is the fund managers are just too busy to put information out. They're literally just too busy, and marketing teams are clamoring to get 30 minutes with them, so they can either do a video, get a piece. So how does if an asset manager's marketing team, all the people on this call are all marketers, how would somebody go from what would the process be for taking a fund manager who's short on time, high on ego, to take content and deliver it to the user? What are your best practices to do that?
Yeah, I mean, actually, when I spoke to people for this report, so the asset managers, and I was asking one of the questions, it's not sort of here today, but how do you produce this content? Who is actually writing it? And it's not very helpful, maybe, for everyone on the call to say it's different for every firm, but it is. I mean, you get really great fund managers who are willing to put some work into it. Some firms have content teams, or it's working with investment specialists or some of the analysts. It really is very, very different for each firm. But I think the main thing is, if you've got that time with the fund manager, then you make the use of it and you repurpose that as much as possible, or it's sitting in on other calls with them. So if they've got make it as efficient for them as possible. I mean, if they've got sort of client calls or investor calls, we've sat in on those before, listened in the background, taken notes, and then we can come take that and turn it into something useful and coherent for whoever the audience is, and sort of run it back by them, make sure they're happy. But it's making it as efficient as possible a process for them. And I think also if they do take the time to sit down with you, I mean, make sure you do deliver something, because the worst thing is for them to feel that it was a waste of their time. It's the same if they're doing an interview with a journalist, they want to know that that's translated into something meaningful and it's worthwhile of their time. But I think that, I mean, there are lots of ways, there's lots of internal documents, lots of internal emails. I think getting hold of that, or as I say, sitting on the calls, where they're not having to repeat something they've already done. If it's out there in some channel already, then use that.
Yeah, that's a really good point. That's really just aligning the content team with the fund team.
Yeah, absolutely. I mean, look, I mean, it all depends on the size of the firm. I mean, not everyone can have content teams, obviously, but you know, if you've got an agency, you know, use them and get them to sort of help you with it, or the investment product specialist, also pretty good, and they're sitting on in a lot of these meetings as well. So using the skill set wherever it is, it doesn't always have to be the fund manager if others are hearing their views as well.
Fine, excellent. It's a great slide, and what I found was the call to action thing. I thought that would be higher, but hey, you know, opinion. I mean, you know, I think people. It's really interesting that what I find in the content we distribute for people really do shy away from giving an opinion. But the two best performing, so we've got, you know, 300 users, no, 300 people who send out content using our platform. And of those 300, 2, which are the most engaged content, always have opinions on them. They always have opinions, and it's very hard to kind of get people over the chasm to say, look, you can put an opinion down, but everyone is almost, you know, the nature of compliance is to say no, that's what compliance does, and rightfully so. But these guys tread a really good line between giving advice, which they don't do, but giving a very, very strong opinion. And tying back to the first slide, they don't do this every 2 days, because how can you change your opinion? They do this on a regular scheduled basis. So people are almost looking forward to that opinion. You know, so
exactly.
Yeah.
And that's a good point, actually. It's that regularity as well, so that whoever the audience is, they begin to come to expect this piece of content, which again, that helps you cut through the noise when you've got 1,000 other firms also.
And builds trust. And builds trust. Absolutely.
Exactly.
Yeah. So there we go. What content works? This was spooky. Self-perception.
It is. So actually, when we did this back in 2019, and I will touch on it, the first slide always made people laugh. So basically what this is, it's from the same report again, but rather than looking at content, it was talking to asset managers about how they view themselves on ESG and their own credentials and expertise. I mean, you can't talk about asset management without talking about ESG these days, obviously. And back in 2019, I mean, almost half of the firms we spoke to all believed they were pioneers in ESG. They were blazing a trail for the rest of the industry, well ahead of everyone else. And I mean, by definition, not everyone can be a pioneer, but most of them seem to think they were. And there's been a massive sea change, thankfully, over the last couple of years, where, you know, most people are in that sort of middle bracket now in terms of where they think they are. And there was one firm actually that is actually a true pioneer in ESG. They're specialists, it's all they've ever done. And even they told me this year, I don't think we can say we are anymore, because the industry's caught up. You know, we've got 30 years track record in this, but who can't sort of drag up 30 years from somewhere? Everyone seems to be able to do that nowadays. So I mean, I'd say it's a good thing that there's a bit more introspection about this. And I do think this is going to be a key part for any sort of sales, marketing, comms for asset managers, certainly in the next year, because there's so much regulation coming down the wire about marketing and the labeling of funds. I mean, maybe sort of 2-3 years ago, when we were talking to asset managers about ESG, and they said, actually, the reason we're feeling less and less confident about saying we're a pioneer is because there is all this regulation. So there was SFDR, which is the Sustainable Finance Disclosure Regulation. So I have to make sure I've got that right. So for anyone that's dialing in not from Europe, that's a piece of European regulation that was introduced to kind of improve transparency around sustainable investment products, so that investors knew what they were buying. And a lot of managers I spoke to over the last couple of years said they were being far more cautious and conservative in the way that they categorized their funds under that regulation, because they were so fearful of being seen to greenwash. And they said, well, we can upgrade them over time, but we don't want to be seen to be on the wrong side of the fence. And obviously not every firm got the memo, because there were quite a few firms recently in the last month that have been forced to downgrade their funds under that sort of regulation, and there's even more coming down the wire. So even a couple of weeks ago, the FCA in the UK is starting a new consultation again on the labelling of funds, but even getting far more granular about terminology that you can and can't use, and where you can and can't use terms like sustainability or green or ESG. And I think Europe in the same. I think ESMA's doing the same sort of consultation right now. So I think from a reputational perspective, this is going to be very significant in the next 12 months. I think we've already seen lots of fines and penalties issued, but the way that you choose to market a fund, the way that you describe what that product is and whether you could say it's business development, sales or marketing, but actually if you're integrating ESG into everything you do, it should flow through. And I really think it's going to be a key factor in what you say and how you say it in the year ahead in terms of marketing, and it potentially may be a big reputational issue for a lot of firms.
Oh no, for sure. I mean greenwashing is kind of rife, isn't it? I think people don't really understand the consequences of kind of saying, well, you know, we are an ESG fund, you know, and we are, you know, and we're investing in clean tech, and then, you know, what's the definition of clean tech? And, you know, we had and naming no names, we found some content that was talking about ESG content, and it seemed plausible, but the green companies that they were investing in were just buying carbon credits, right? So it's a little bit like, well, how does that line up? Okay. So I think that the deeper you go, I mean, look, the deeper you go, you just don't want to get caught out.
No, and the interesting thing is, I mean, even on the panel that we had at the investment seminar, they were saying it's also not just what you're buying and what you're investing in, it's also you as a firm. So you better live up, if you're holding others to account, you better live up to it yourself. So if you want diversity on the boards of the firms you're investing in, you better have diversity in your own firm as well. So it's about you as much as what you're investing in as well, and living up to that, and living and breathing ESG in all its forms. Although I think the acronym is falling away now, because it means too many different things to too many different people, and people are beginning to look at the sub-strands, I think, whether it's climate or social or governance, because they're all quite distinct from each other.
Yeah, and they will do, and like with anything, it will all evolve over time, whichever acronym you do. And, you know, and the danger is, you know, I mean, you know, ESG as a concept. So we're kind of looking, you know, does this ESG, does it manifest itself at the activist investor level? So there's one way to kind of look at this, or does it work at the, you know, at the wholesale, you know, pension fund level? You know, which one has more impact? And speaking to more and more people, it feels like if they don't get it right, they're going to get screwed by both ends. You see? So it's, you know, and you know, speaking to the head of, you know, I mean, we're very blessed that we know the top 100 funds, you know, a fair percentage are our clients. And going out with one, this is, you know, we just talk about the risks that they're looking to mitigate over the next 2 or 3 years. And we were talking about technology, but they're actually talking about, you know, the balance between, you know, the institutional investors and the activist investors, and having them. And they said, I can upset one of them and I'll be okay, but if I upset both of them, it's just going to be a nightmare. So what they're trying to do in their business is literally, if you cut them through, just like you said, they're ESG through and through. And that's from how they, you know, provide, you know, cycle loans to their employees, how they, you know, how they're, you know, helping employees, you know, get their houses insulated, even though they say it's a government problem. They're kind of doing these things, and, you know, whether it's a good thing to do, personally, I think, but obviously they're under pressure to do it. So, and that's behavioral change in society as well, you know, that, you know, because nothing makes you change your mind more than, you know, financial pressure. So let's hope. But I do think greenwashing's had its day, and I'm glad there's kind of regulation around this. But, you know, as you said, you've got to kind of live it, you've got to breathe it, and you've got to be it.
Yeah, absolutely.
So that's I really found this was really cool because it almost answers the question. You know, your next slide should be how self-aware are these managers? But we'll leave that for another day.
Yeah, I purposely didn't put that in. So
you said one.
no,
Okay.
no, I don't. I'll be fair. So this last slide, actually, this is from the seminar that we had last week that you were at, Paul.
Yeah.
So we've just got the one slide, but I thought it's quite useful for today, which is this was research into the changing priorities of asset owners. And so we spoke to senior decision makers at 32 pension funds, platforms, wealth managers, fiduciary managers and consultants to get a sense on a range of issues, but their satisfaction with the current asset managers that they work with,
Right.
where they expect to allocate capital in the year ahead. And then what this slide is touching on was what's most important to them when selecting new managers. And there's actually a short white paper coming out on this as well. So if anyone wants that, feel free to get in touch. But this slide is taken from that research, and you can see from the results here, actually, it was quite surprising that record of outperformance was the least important priority in terms of selecting a new manager. Actually, some of the most important for asset owners are things like the stability of a team, the continuity of a team, the cohesion of the team, and the quality of them,
Right.
and also the articulation of a positive corporate culture. So, I mean, it's kind of almost more those like human, personal aspects, and again goes to kind of telling that story and bringing out that sort of personal element into what you do, and it should do. I mean, it should flow through from, you know, whether it's PR and communications through to marketing, the website, the RFP, through to the final presentation itself. I mean, it's an opportunity to tell that kind of authentic story. And it's I guess it's a line between sort of, I think you talk about this, but that line between marketing and sales.
Yeah.
But it's that sort of personal point is really, really important. You might remember this, one of the people on the panel said one of the biggest issues they had in terms of managers presenting to them over the last sort of 30 years has been when one person just dominates a presentation, they talk over everyone else, and the rest of the team don't get the opportunity. And it goes to that, they said it demonstrates poor corporate culture. It doesn't really show the stability and quality of the team. It shows the sort of the one person, and kind of all of that really feeds in, I think, to marketing, because the whole point of comms and marketing is to get you really to a point where you can get into that room and sell your product. And when you get into that room, you should still be marketing yourself. You know, the marketing doesn't end until you've got that mandate. And marketing doesn't even end then, because you've still got client service. And I'd argue that's probably a form of marketing as well.
Yeah, it is. And marketing, you know, it's one of those things and what is marketing? You know, you can spend years discussing it. You know, marketing is creating that subjective value, but marketing as well is telling the story. And the story doesn't need to be in paper. It's how you're presenting yourself, and you're right, your corporate culture, and what are you about. And, you know, our data, and we've had 20 years of data on this, and whilst most managers, and this is what I was talking about, the ego thing, will say, oh, it's all performance, performance, performance. Actually, it's more about attitude to risk, investment strategy, and then performance. And it's a little bit like, and that's why these two worlds have to kind of align themselves, because, you know, if you think about marketing and marketing spend, you know, it's kind of it's the poor cousin of sales, it's the poor cousin of the portfolio manager. But actually, you know, my hope is, as time goes on, and as people kind of, you know, become more aware of what we're speaking about today, that marketing becomes a core function within the business, and is not what you recruit for when the sales team have just kind of run out of steam about sending things out. Because you know, and it's very much the left brain, right brain, is that, you know, most portfolio managers are economists, mathematicians, and, you know, the CEOs are generally accountants or chartered accountants. So they just don't understand the value of creative. And the trouble with creatives is they find it very hard to convince, you know, the other side of the brain, left brain, right brain. That communication breaks down. So I mean, that has to be aligned. And having something like this definitely tells somebody who's an economist or an accountant that, you know what, this data, and kind of going back to the first slide, is where, you know, you need to focus just to get that marginal gain in your marketing.
Exactly. And I mean, the point on, I guess, performance, yeah, it's not everything. Obviously, if you've got very poor performance, that's going to make it much more difficult for you. But it's those other elements, as you, I mean, you named a few, but it's bringing out that personal story and telling the story of who you are and the team and why they want to be investing with you. And it's funny. So I mean, there was a kind of slight deviation, but I had this exact experience a month or two ago. I'm a chair of trustees for a charity, and so we had a set amount of capital to invest, and we had an investor, well, an investment firm come and present to us, and it was very interesting being on the other side of the fence because the presentation was really poor. Right. Really poor. So, I mean, in fairness, the product was incorrect for our needs, and the time horizon was mismatched, but they didn't address why it was relevant for us, why they had suggested this particular product. They skipped over most of the deck that they had, which makes you think, well, you haven't exactly made a bespoke presentation for us then, you're just putting out 2 or 3 slides. And there was kind of an open goal really to kind of to talk about a relevant product, and they didn't. And so, I mean, that's shame for them, but at the same time, it also, from a marketing perspective, if you think of it as a form of marketing, leaves you as a potential client thinking, I'm going to have a bit of a bitter taste about that firm, and I probably wouldn't invite them back because it's a really missed opportunity, because there was no thought about the underlying client. And that's the other key thing. It's convey your own corporate culture and the stability of the team, but also make it as relevant as possible for them, which goes back to that first slide. Really, it's about making things as relevant for your client. That's you know, and that's often a point that people miss. No, for sure. And you know what we've found, and this kind of like is a nice segue onto what I'm talking about, is what we've found is that a lot of marketing, you know, and the whole asset raising process is, you know, people say, well, how do we find these people that we need to raise money with? And, you know, whilst, you know, most marketing companies talk about, you know, SEO and ads and platforms, what we've found last year, and this is again data that we've been collecting, is that the most efficient way to engage with investors and investors and prospective investors is reaching out to them on social platforms like LinkedIn and physical events like networking, because that really ties in. Because, you know, over Zoom, it's very easy to make no effort, right? But when you meet people, you're making effort, and it is those buying signals, those non-verbal elements that, you know, people buy from people, whichever way you look at it, whichever industry you look at it. You know, my best friend sells locomotives, and, you know, these big diesel locomotives. It's like, how do you sell, you know, how do you sell a locomotive, right? He said, you just got to be in touch with people all the time, you know. And during the pandemic, people say that's the thing that got missed, because, you know, when you're selling these, you know, 50 million bits of kit, people want to know the cut of your jib. And it's the same with funds, right? If a pension fund is going to invest their money, they want to know all about you. And it's not how slick your, like you said, it's not how slick your slides are. It's everything else that you're doing, from your LinkedIn profile to your corporate communications, to your market communications. It's, you know, when you cut through the brand, it has to exude what you're talking about. And that's our research. And I found, and then, you know, what we could encourage people, our data show, is that encapsulating that within email campaigns and nurture campaigns is kind of the way to take content that, you know, people like yourself produce and kind of start to distribute it. So that, I was going to say, actually, I completely agree with you. And I think the reason we've seen this, that, I mean, if it's events, Zoom, all of that sort of stuff, it's great and it serves a purpose. But as you say, people are probably doing other things and checking emails while they're on it. But actually, the way you build trust is through knowing people and being in front of them and them seeing the whites of your eyes. And I mean, some of that, it was again different piece of research, but we did that. A lot of pension schemes were telling us last year, I think they were very keen to get back in front of their asset managers and have that sort of one-on-one FaceTime. That a lot of them were really sick of Zoom by that point. So it is, I completely agree with you. You're absolutely right. It's that face-to-face. It's a networking. It's building a relationship.
It is, and we're delighted our competitors are on Zoom, because that's great for us, because we're going out and seeing people. So that was last year. I think I think there is a move to kind of a direct to consumer strategy that people are taking on with platforms. And, you know, the thing, what we kind of broke this down to is like, what are the 4 things that managers will need to change? Is 1, rationalize their cost structure, build open architecture to connect to these platforms, and look at other areas to invest in as well, so they can make their offering, you know, that much more diverse. But the one thing that we definitely think managers need to be thinking about is how do they rethink their marketing? Because when you are going from, you know, the direct, when you're going to marketing to hedge funds, sorry, to pension funds and wholesale banks, or, you know, institutional, is very, very different to how you market directly to the consumer over a platform. And more investors are looking not to just go to their bank, so, you know, who offer a set of funds, but they want to go deeper. They want to, you know, they want to look at ESG funds. They want to look at carbon neutral. They want to, you know, the investors are getting more money. They're more educated and are not passive anymore. So marketing has to change, and that's why I think companies like yourselves have a major role to play, whether, you know, asset managers realize it yet or not, because the voice of the business has to reach out to the people they're targeting. I'm just kind of repeating what you just said earlier on. And, you know, and really what we've kind of worked about on our product, the thing that we're focusing, helping managers do is to use people like JPES to build out their fund narrative. It's like, what is our fund about? How do we explain our fund consistently over multiple channels, whether that's email, social, reports, research, investor portal? What is our fund narrative? And then, you know, delving deeper into say, right, we've got our fund narrative, you know, who are our ideal investors and where do they live? And how do we engage with them on these channels? And then what content do we provide? And that's really, you know, where content becomes so important, because you've got to have the right voice, it's got to match the narrative. And once you've got, you know, the narrative set out and you know who your ideal investor is to then work out, right, will this work? So that's where products like ours come and say, right, let's go and find potentially our top 100 investors. Let's run a campaign on them and see what's working, what themes work, what narrative work. And then based on that, do some testing to say, well, actually, the engagement was absolutely useless. Right. So either the narrative is wrong, or the investor profile is wrong, or both are wrong, or the content's rubbish. So it's kind of the go-to-market strategy underpins, in my mind, you know, how people can take and invest in great content that people produce, but then are able to distribute it and not just fire and forget, but to keep iterating on getting the content to actually have an impact on assets being raised. So that's something we've found, Miles.
Mm. Yeah, no, I completely agree. I can't add any more. I think you've hit the nail on the head.
Right, and this is how we lay it out. So this is so when people say, oh, we want to do marketing, we want to do fund marketing, and we're pretty much at the last slide now, is okay, where does this all sit? You know, where does a JPES sit? Where does a ProFundCom sit? Where does our marketing sit? And what we've kind of worked out, we've kind of laid it out into these 5 steps. So something like, you know, if you're going to have a go-to-market strategy, you need these kind of 5 pillars. And the starting point is narrative and brand. So the starting point of narrative is pretty much, you know, creating the content. What is your fund about? Having professional companies like JPES create that content for you, create that research for you, and then tying that into your brand. So whatever your definition of brand is, that's the next step on a go-to-market strategy. So once you've kind of got that, you can then build out your, you know, your demand generation, your engagement models, and your analytics. But the first thing, the trouble is, most people, when they say we need to do marketing, what's the first thing they do? They build a freaking website, right? And so we've got a great website. And it's like, okay, let me guess. You went to a marketing agency. Yes, we did. They do websites. Yes, they do. And that's what they sold you. Yes, they did. And let me guess, they then said to you the content will follow. They did. okay, it doesn't work.
No.
And I don't know if you'd agree with these steps, Miles.
Yeah, absolutely. And I mean, it's you start with the content and who you are and that corporate narrative, and then you figure out what channel actually is right for you based on what it is you're saying and what's right for that underlying audience, because different channels will work. I mean, the only thing I would say also, absolutely, you start with the narrative and the brand, and you begin to kind of figure out the right channels and where you send that information, and then analyze the data you get in. The one thing I would say that often happens is a kind of a misstep, actually, is it's all about getting that new client and getting the fund into new places, and sometimes a misstep in terms of you've actually got existing clients, and it's harder to win a new one than it is to retain, as everyone knows. And I think that's also a key part, I would argue, again, of marketing. I think marketing is a much broader suite of tools. If you've got clients already, it's also understanding, is it actually, is the product working for them? Are they satisfied? What are they not happy about? And, when we do lots of perception audits of underlying clients, but actually there's no reason asset managers shouldn't be also talking to their own clients or getting a third party, but to do a client satisfaction audit. And not just clients, but also if you've lost a pitch, then also bringing that into the mix. If clients have terminated, a perception audit that actually understands why a client left, why you didn't win a client, or why a client is still with you, and get a real sense of what they want from you, and then feed that back into your sort of marketing channel and your client comms and everything else. But I think sometimes people don't want to know how people view them in case there's some negatives there, so they think it's better to not know. But actually, you can find out and anticipate some issues if you just ask the question. I think people like to be asked.
Yeah, that's a scary thing, isn't it? Because we don't really want to know the answer.
No, from anyone in our life, we just think, let's pretend it's all okay.
Yeah,
but I mean, but it's important, because you are always at risk of losing a client if you don't know the challenges that they may have with your service.
And so, what is a perception audit?
So a perception audit, I mean, it's actually the methodology I used for the first piece of research. And it's rather than, a lot of surveys are sort of online, tick boxes, or, people really don't want to go into any great detail when they're doing an online survey. Perception audit is where you'll have really in-depth conversations with, whether it's 10, 20, 30, 50 people on a range of sort of topics. You outline what the sort of questionnaire is, but it's more to get that sort of qualitative view from them, and really in a conversation of half an hour, you really drill down into things in much more deeper detail and get a much better sense of what they want and don't want. And it's invaluable. I mean, we've won clients through doing perception audits, so believe me, it's definitely worth doing.
Okay. Well, super. Well, look, that's the end. I think I'm hoping that's the last slide. Oh, there's one more. That what we're looking for next year is nurture campaign and lead scoring. I knew there was one more. And that's basically where you take all your channels and actually work out which channel is working. You basically collect that data, categorize it, and then score it. So you can just feed that back into your sales team. So that just completes the virtuous circle of the spend on marketing to actually raising assets. So that was my last slide. So we've done well. We've kind of kept it to just under the hour. Wow, that flew.
I know.
That flew. Time flies when you're having fun or falling asleep on the Zoom, right?
Absolutely.
So listen, Mars, thanks for your time. I really appreciate it. We've got a whole bunch of people still on the call, so we haven't bored too many. Is there any questions before Miles and myself head off? Oh, we've got one question come in. Faith. So Faith's question is, you were speaking earlier a lot about content, how content should be written, but do you have any research on what we should be writing about? I'm thinking here especially about the press. What are they going to want to hear about? What pieces of content in terms of subject matter will they open and read?
Okay, yes, it's a good point, because I didn't actually sort of talk about that. Well, actually, again, Paul, you would have seen this at the seminar. We did have a slide there on some research that we do each year on actually what we predict will be the key themes going forward in the investment media. And it's always difficult to predict actually when things like Ukraine and Russia happen, and you just can't predict that. But yeah, so the research we do is kind of looking at where there may be momentum over time for certain topics. So we have about 20 or 25. We actually ask journalists. We get about 20 journalists to respond and say whether they expect to write more or less about a particular topic. And there were 3 or 4 real key ones that came out of that research for investment media anyway. And so geopolitics is still there, obviously with Ukraine, Russia, but increasingly with China as well. It's a huge topic. But the 2 other main ones, transparency, goes into ESG reporting data. There's lots of issues around that. But lastly, actually, the interesting one was social equality. And it kind of goes back to what we were saying earlier about ESG not being an acronym, but getting down into those individual verticals, and whether it's social equality from pension provision, cost of living, all of these things. But certainly on that sort of ESG spectrum, social is an area that's been quite neglected, and that's, I think, going to be key for the year ahead.
Yeah, and the other thing, Faith, as well, is that, if you've got a marketing analytical platform like ours, what you've got the ability to do is actually week on week, month on month, do thematic analysis to actually see what themes are resonating and which ones aren't. So hopefully that answered your question, Faith. You've got another question here. Please discuss your experience with dominant founders, secondary founders, and communicating corporate culture, making the founder less, let me stop there one second. Oh, less dominant. Wow.
Okay, that's quite specific. I assume this person obviously works in a firm with a very dominant founder, I assume, or certainly has done.
Yes, and anonymous as well. So.
It depends if that dominant founder still owns most of the business, I guess, then it's quite difficult. But I mean, I would say it's less just to do with the dominant founder. I think it's good business practice in any firm is to have less of that star manager or that one voice, but actually show the breadth of experience, the breadth of expertise across the firm. And so, we always advise clients as much as possible. You want to have a good, a good range of voices and diversity of opinion, diversity of spokespeople as well. So I'd say a good starting point let's say from a press perspective, but is to identify a range of spokespeople and make sure you're building their profile as much as the founders, so that actually you start to get other voices recognized in the industry, and a range of faces out there, not just the founders. That would be a good starting point, I would say.
Yeah, I mean, the interesting thing is, the word dominant founder. I mean, a dominant founder, is that because they're unlikable? An unlikable founder is one way of looking at it. Or are they dominant? Is that, what does that word actually mean? Because we're taking our own version of it. And I think if you've got a dominant founder can also be a benign dictator. So, there are various ways to look at this, and I've worked with a whole bunch. Now, it also, as you said, Miles, it depends on the investor type. If the investor wants to invest in a superstar manager that's getting them great returns, then actually you don't really need a comms team. But I think what's being said here by Anonymous is that, they may be getting, the dominant founder may be getting in the way of the whole comms. And, the anonymous person here has enough integrity not to say, well, sack it, I'm going to go somewhere else, but let me persevere. And
the one thing actually I'll say though, about, you can have a star manager and they'll bring in lots of assets because everyone thinks, well, they're just great at what they do, but you better keep that manager.
Yes.
And then you need a good comms team, because if you lose them, your assets will walk out the door. So, and again, that goes back to, you might have a star manager, but you've got a real key man risk there, and so you probably do need a good comms team to build a profile of everyone else.
No, absolutely.
Make sure that the rest of your funds are getting as many assets in as that star manager.
Yes, and also, on the same side, being on the same side, is that the one thing that I know unlikable people like, right? And everyone loves acknowledgement. So the reason people get unliked is there's an element of acknowledgement, but what unlikable people are very good at being, if you want to disarm an unlikable person, just give them the data and just leave it with them. It says, look, here's the data. here's what we're getting. Pieces that are about you get X traction. Pieces on this theme get better traction. You know what? I'll leave it with you. You decide what to do, because guess what? You are the brains. You know, and then there's an element, then, you know, there is a realization. Now, it could take a week, a month, a year, but you've got to almost, you can't go with feelings, because if you go with feelings, you'll just get slapped out of the park. So, and I know that because I've been there. So my sympathy is anonymous, but fight the fight, use the data, you'll be fine. Now, we've got a few hands have been raised. So we've got Christine's raised a hand. So I'm going to ask you to come on if you want to. So Christine, do you want to come on? Cholpon's come on. Cholpon, have you got anything you want to add?
Hi, Paul. Hi, Miles. I have got
Hi.
a question about how to best communicate your story, because we talked about, you know, not just about performance, but also communicating what kind of culture and ethics you have within the organization. And I'm thinking of recording a video and telling the story why we created this fund and what is the reason, what are we looking for. Is it something you can help with, Miles?
Yeah, absolutely. I mean, I think it's the starting point for any good communication strategy, first of all, is to sit down and actually work out what that corporate story is, what that corporate narrative is. It's difficult to find USPs, but actually most firms do have them, and it's understanding what differentiates you from your peers, and certainly from a cultural perspective. What's the story behind your firm, and also if there are USPs in terms of the investment products, also understanding what they are. And so I would always say that's a good starting point to work out what it is at a firm level you're trying to say, and then you can kind of drill down from there, and you can get all of the proof points. And you can't get all of that into every piece of content, whether it's a video or something else, but it's making sure that you have a consistent voice and a consistent message where you are conveying those key messages as often as you can. Yeah, video can be really useful. I mean, PR can be useful if it's strategic, and I don't mean sort of just adding your voice to the mix and having quotes everywhere, but where you do get those sort of profile pieces, there are, you know, so it'll be at a more C-suite level, but where you're really able to convey your vision for the firm, the ambition for the firm, and how you see the firm growing over the sort of coming years. And if you've got that third-party endorsement from a credible media house, not something paid for, but where it is credible, then that can go a long way. And you can use that as part of your marketing as well. You can buy the rights and circulate that in different forms. But definitely, I'd say the starting point is to sit down with an outsider who isn't tainted by the kind of, hasn't been drinking the Kool-Aid, and actually work out what that corporate narrative is and where your real USPs are versus where maybe some internal people may think they are, because sometimes there's a gap there. And then relating that all back to actually really what clients want from you. So working out what that is, and then you'll figure out the right channel, whether that's video, PR, or whatever else it may be.
Right.
Thank you so much, Miles.
Thank you, Cholpon. You're not anonymous, are you? You don't have a founder that's dominant.
Is that me or Cholpon?
No, Cholpon, but that's okay. I'm not gonna. I know Tony. He's a great guy. Right, but on the hour, we've got Miles. We've got lots of people asking for the white paper you've mentioned before.
Yeah, absolutely. We're very happy to send that out. I don't know if you've got everyone's details, Paul.
I do. What I'll do, if I get the link off you, I'll put it on the replay that goes out.
Great, perfect.
Super. Okay,
Fantastic.
Erica and Colin, hope that addresses your question. Right, we're on the hour. We're not going to take any more time. Thank you, everyone, for your questions. Thank you, especially for Miles, for your insights. And is it too early to say Merry Christmas and Happy New Year?
Never too early.
Never too early.
Merry Christmas.
Great. We'll see you all in the new year. Have a great holiday season. And yeah, have a great 2023. I hope you found it useful. Oh, we've got one more question. Oh, thank you. No, it's a thank you. Right. Okay. Bye for now.
Thank you. Bye.
Bye-bye.